Hello Proponomics people, and this is the video from Monday the 8th of April 2024. And this one is in the form of a short summary of the Sunday supplement from yesterday that I published, which I entitled Train on the Tracks, ? And the reason for the question mark was Halifax printed a 1% drop in their house price index for the month of March. Seemed a bit strange to me, didn't look particularly congruent with the other things that were going on and we were seeing in the marketplace, but I thought rather than sidestep these things, given that I've been going on about how I'm so bullish over the next 5 years or so in terms of the UK property market, I thought I'd better address it head on, realistically. So that's what I tried to do. So I always use the first part of the supplement to discuss 4 macro metrics of interest, or more accurately 4 macro areas of interest. I usually discuss more than 4 metrics because I can't limit myself to only 4. There's too much stuff that's important, and obviously the house price indices made it in, which we've got to discuss. So Nationwide printed minus 0.2 and Halifax minus 1. Both of those were well under the consensus figures that everyone was expecting. And then the excuses came out, it's mortgage rates hardening and all the rest of it. Look, we did have some nice mortgage rates at the beginning of the year. It was strange to see last week because it was a bit confusing for some people who don't necessarily drill down into the headlines, because mortgage approvals were up according to the Bank of England. But that was for February, and they get into the money and credit report from the bank later on in order to put some colour around that as well. So minus 1, but when we look, plus 2 for the quarter according to Halifax. So nothing too dangerous just yet. They're blaming affordability in general, which of course everything's a bit less affordable than it was, and the price of shelter has gone up for renters and for homeowners. There's no two ways about that. But of course we've just seen a big increase in wages. Not everyone will have their pay rises in April, of course. Some companies in January or February, or sometimes the anniversary of your start date. So it's not a massively uniform thing, but we would expect April to be quite a lot of a better month for the overall household disposable income metrics that also we'll get into later on. I also think there's still no understanding of inflation in all of these things, in all of these forecasts. They're not really listening, and they're not seeing that inflation will take, when they're sitting there discussing nominal prices every month, inflation is a factor. It's still a bigger factor than it's been, apart from the last few years, for decades and decades. We've still got core inflation at 4.5%. Right, that strips out all the noise. Forget about CPI and all the rest of it, and energy bobbing up and down and all the things that the energy price has done to the inflation rate. Core inflation is 4.5%. So just remember that. That would be a fair proxy, and that's certainly where I started at in terms of where do I think house prices are going to go this year, because I think they'll be dragged forward simply nominally by inflation. Will they go up in real terms? That's a different question that none of the forecasters ever tried to answer. I tried to answer it, and my answer was maybe just a little bit, but it'd be very close in reality. 1% either way probably of the actual inflation rate, but it depends what you believe the actual inflation rate is, of course. So on to the mortgage approvals. As I said, 60,000 was the number that was breached in February. A good news, 60,000, the last 10 years average of mortgage approvals. Bit concerned about the last 10 years average, because how do you consider what happened during the pandemic and all the rest of it? I prefer to look at 2014 to 2019 as a relatively healthy and stable market before too many crazy things happened. Obviously we had the Brexit referendum, and that did affect house prices in some parts of the country, but nonetheless it seems about right for that to have been a pretty stable market, and that looked between 65 and 70,000 approvals. But with rates where they are, I think 60,000 is as good as it was going to get. And I also think if you trust the Halifax and the Nationwide prints, then ultimately we're going to get a lower number than that for March's report when that comes in at the beginning of May. But we'll see, because the sales agreed statistics that are calculated per square foot and distributed every week by Christopher Watkin, who I'm a big fan of in terms of the data that he distributes. It's an absolute public service to the industry, and for nerds like me, I absolutely lap it up. And Chris showed an increase of about 1% and a bit in March for sales prices agreed per square foot. And that feeds into the ONS data with a very strong correlation in 4 or 5 months' time, because he's talking sales agreed from agencies, and we're talking when the deal gets over the line and the price hits the land reg. And we're looking at about a 25% average now these days at the moment of deals falling through, and we're looking at just over 20% at the moment. So a pretty strong market. That average not so long ago was more like 33%, so that was a significant change really. So good news, I think, on the mortgage approvals in general, but we expect to wobble when March's numbers come in. Then the PMIs, the darlings of my real-time statistics. I'm a big fan of the PMIs, purchasing managers indices. What do the purchasing managers in the big companies say is going on? Services disappointed ever so slightly against the consensus, but still made it over the magic 53. So remember, 50 is not growing, not shrinking. And both manufacturing and construction made it over 50 for the first time in a whole number of months. So it looks like perhaps this is the start of the difficulties in those sectors caused by inflation, caused by the pandemic, caused by disruption. Perhaps it's the start of those being over and they can return to a bit of normality. So we had a composite print of 52.8, which is perfectly healthy and cements our growth for Q1, in my opinion. And my estimate of that GDP growth before the number comes out is 0.4%. We'll have to wait a couple more months to see how close I was with that dart, but I think that should be about right. And then always get stuck into the bond yields as well. Not the greatest week. We lost about 0.1. Yields went up from about 3.8 to about 3.9. That means rates getting more expensive. Why did they do that? Well, the economy looks in relatively good health in spite of all the negativity that there is totally surrounding all of this. Is it going to save the election for the Conservatives? It looks like absolutely no chance in the world. The polling numbers are absolutely insane. There's been talk this week of 400-seat majorities, and Canada 1993 is being mentioned left, right and centre, which is where the ruling party in Canada, which was the Conservatives at the time, returned 2 seats when they had a general election. It's not over till it's over. Let's see what happens. I think there will be a little bit of feel-good factor and things will certainly feel better than they did in the back end of 22 and in 2023 within a few months, because people have had wage rises, but ultimately those tax thresholds being frozen, that Conservative vote that sits in and around the 50,000, 60,000 a year household income, those people are not feeling better off. And of course the recent tactics have been squeeze the pensioners a bit, give the employees a bit more in terms of national insurance cuts. It's very difficult going after the pension vote. I don't know whether they're banking on the fact that as people get older, they're more likely to vote Conservative and they're hoping that holds up. But let's see. It seems that the country's sick and there's inevitably going to be a change. So it does look highly, highly likely at the moment. And then I got into the Bank of England money and credit report, as I said. Less borrowing in February for individuals rather than January, but don't read too much into that because people always borrow money in January to plug the gaps after Christmas. Effectively, we're paying 4.9%, or we did in February, on new mortgages that were drawn. So that the average rate, but the average rate that's actually outstanding is 3.48. So there's still quite a gap there between the new money that's coming in and the existing stock of debt. So my fear here is that the Bank of England ultimately are not really encapsulating exactly how much of this interest rate rise has been fed into the markets as yet. And we're gonna find out how that is. And also the other bit I wanted to draw out of that was the money supply has been back on the rise. The money supply, often cited by the monetary school of economics as a big driver of inflation. Money supply has been becoming much more under control, and we are sort of back at levels that we were at in March 2022. We compare very favourably to the US in this metric. We're about 22% above where we were at the start of the pandemic in money supply. And if you think about it, inflation has been about 22%. Again, depends on how you measure it and what you're measuring. If you're measuring construction, it's been a lot higher. If you're measuring insurance, it's been a lot higher. If you're measuring rent, that's been roughly about right, maybe about 25 for rent. But then if you used RPI, the retail price index instead, inflation would look more like 30 than it would 22. And there's all sorts of arguments to use all sorts of inflation metrics, which I won't go into in this video. So smaller businesses also struggling a bit more to lend than larger businesses are, but generally speaking, businesses are paying down debt because either A, they can't find things to invest in that are worthwhile and make money, or B, they're concerned that the cost of debt is too high. So that's not good on an ongoing basis, and that's a good reason for the interest rate to come down. Although the Bank of England is relatively short of good reasons for the interest rate to come down at the moment, because the rates are high, but everything looks fine. They know they're in a tightening phase here, and they can get rates down a bit, but we might be quite disappointed this year if we're hanging out for lots of interest rate cuts. That's all I'm going to say. And then to finish off, we had the ONS quarterly sector accounts, which again I really like to analyse in some detail. Household savings ratio is important because that speaks to consumption and how much we're saving or not in the economy, and we're still saving over 10% in Q4 2023, which is the quarter we've just had the figures for, 10.2 up from 10.1. Normal times you look at more like 7 to 8%. So people are still worried about geopolitical news, perhaps worried about the upcoming election, perhaps still worried that inflation wasn't under control. But last quarter, as in Q4 2023, and the quarter we've just got out of, because we're recording this early April 24, look very, very different, I think, in terms of optimism, in terms of interest rates, in terms of all sorts of stuff. So perhaps that's just the old sentiment rather than the new one. We'll have to wait another 3 months to see what the savings ratio is for quarter 1 24, I'm afraid. Real household disposable income, that's the big bit I like to come out of this report, up by 0.7 last quarter. I've theorised it's going to be up by quite a lot more in 2024. Why? Well, there's huge rises in minimum wage apart from anything else. I mean, 9.8% is massive. Inflation, if you take CPI as the proxy, 3.4. If you take CPIH, including housing, 3.9, as those big rises have kicked in. So on the face of it, huge increase. What's going to be put on top of that? The tax cut for the people who are going to feel that, the people who are employed on lower wages, ultimately they're bringing a lot more in. They're getting another 2% cut off the national insurance. All of these things are significantly inflationary, and perhaps you can see why it's feeding into my models as saying, look, inflation under control, you must be having a laugh, but I think we're realistically hoping we bumble around between about 2% and about 4.5%, 5% over the next several years, the kind of double dip of inflation, and that's going to keep the rates particularly high. There's going to be a lot of pressure to get the rates under 5%, but how low will we go once we get under 4.5 until this secular is squeezed out of the system? And then we'll be struggling for inflation because we'll be struggling to grow, and we're going to continue with relatively subdued growth. I think although 2023's lackluster performance means we've probably got some growth in the pipeline, and I think we're going to have a better year than a lot of the analysts have been predicting, but there we go. Anything else to particularly note from that? Government still borrowing 4.5% of GDP or just over. No surprise there for anybody. Household flows of income monthly have looked like sort of many billions. So households are getting income in, net positive income in, more than they're spending. They're lowering their mortgage debt in general. Mortgage debt in nominal terms is down over the last 12 months, and in real terms it's down an awful lot more. So there's a huge amount of equity in housing, and this is really quite interesting because this number goes up and up and up and up and up, and when a government comes in to power and has to look at where money could come from, the government's not in fantastic shape. I did a video last week on an article that Edward Freeman had submitted to me that was of real interest. So where is the money in the economy? If you look at the households as the shareholders of the government, if you want to use a company analogy, which would be reasonable to do, then where is this all going to come from? You know, when the government hasn't got much in terms of assets and it doesn't look great in terms of cash flow, well, when the households have got £10 trillion worth of property or more and only owe about 1.6 against it, there's a huge amount of wealth in there to potentially tap up. How do you do that fairly? How do you further subsidise that government? Of course, many people will rail back against that, saying government's too big anyway, we need cuts. And that's what we've got baked in for the next parliament. Lots and lots of cuts. Not necessarily in healthcare because that budget's protected. But again, I've shared something on my LinkedIn today around pensions and healthcare, and pensions particularly, and how those two problems that need addressing over the next 20 to 25 years in a dramatic way, and we'd be better off at starting to address them now than waiting until we're at critical mass. But guess what we're probably going to do? Because nobody wants to take on the difficult issues, we're probably going to leave it. That article's about pensions and means testing, whether you go down the means testing route or whether you go down the current route, which is more kicking the can down the road, pushing the pension age out. So we'll be eventually pushing it out to sort of mid-70s, which apart from anything else is going to be seen as extremely unequal, because there are parts of the UK where the average life expectancy is not mid-70s at the moment, and that's not necessarily going to change. But back to real household disposable income to finish off, up 0.7, looking good. I like our HDI because it's households that pay rents, not individuals. This is continuing to push affordability forward. It's going to continue to leave that rental rise that we've been looking at over the last couple of years, which is writing the big change in yields that we've had downwards and downwards and downwards in yields over a whole number of years. Yields are moving upwards at the moment because house prices are moving up or sideways, depending on what you believe, probably not downwards, but rents are moving up at a much faster pace, which is strengthening the case for investment, strengthening the case for buy-to-let property, which actually should be seen as a positive thing, because if there's not money to be made, money's not going to come in there to the sector and try to make it. Not how lots of people politically would look at it, but I'm afraid that is the reality of it, unless we're going to get, public control of this sort of stuff, which will still be delivered by the private sector using public money, which again will have to come from somewhere. So I'm really interested to see how Labour are going to address that problem, because that is going to be a significant problem to get to some of the goals that they would like to see. And then we've got a little bit about net migration and where it's moving to. The Home Office are confident that the changes that have been made over 2023, now if they kicked in, would have meant 300,000 fewer net migrants last year. This is to do with bringing dependents and some of the more controversial bits, but when you look at the underlying statistics, you can see exactly why these changes have been brought in. This became much, much more prevalent amongst migrants who were bringing in dependents, whether that was wives, children, grandparents, parents, all the rest of it. And you can kind of expect that, can't you? Because when you've got free healthcare at the point of consumption, it's a huge, huge driver for people to want to bring their families over. And in theory, now that's been stopped. So what's the number going to be going forward? Maybe 350, 400,000 per year if the flux is over. But of course, Rishi has been out there saying how well he's been doing stopping the boats, whereas 2024 so far has seen more small boat crossings than any other year thus far. So not even sure if that problem that he has blown up to this huge thing, which politically is simply not very sensible to try and make promises that he simply can't keep. But there we go. We'll see how it goes on. I would suggest that by deterring people from bringing dependents over or insisting on higher wages for skilled workers visas or whatever it is, that actually will be a far, far, far bigger deterrent than something like Rwanda, which is a complete bust, as Rishi has said himself. But let's see. I don't usually comment too much on political stuff, but that stuff seems very, very obvious to me. I'm interested to hear from anyone who disagrees. And then I did a 10-point summary of all of this. So I'm just going to read that out to you verbatim. Firstly, real household disposable income is going up nicely. Affordability ceilings are some way from being breached as far as rentals are concerned. House prices are going to need lower rates to really start taking off. The only thing that can drive them forward at the moment is slightly cheaper rates, although a fair bit cheaper than last year, and wage increases thanks to inflation. We're still going to need the election out of the way, but what we've got at the moment is enough to drive them forward, but at least by inflation, as I've been arguing. Yields therefore are climbing, as I said, ascending, not descending. Good news for the tenants, realistically, although you think it might be silly to say it's good news when rents are going up, but it means that it will draw more people into the market to increase supply, and it will actually control some of those rent increases. The supply problem that we all suspected would never be fixed is getting worse and worse than it ever has, and there's more for construction to get worse before it gets better, because it takes time for some of these projects to filter through the system. The average build to rent taking 7 years from conception to delivery. Number 5, inflation isn't dead after all. Anybody who thinks it is, I'm afraid, is just plain wrong. Once the energy cuts drop out of CPI, not that we should be worrying too much about CPI anyway, but we do, because that's what makes all the headlines. But once they drop out and the tax cuts and the wage rises to the level of what we've seen this month, they're inflationary on their own, as I've said. Rates can stay stronger for longer because the underlying economy is doing okay, in spite of the fact that the government has looked pretty useless at certain points. Not necessarily this one actually, but the previous versions of this administration have looked woefully poor at certain points, as you well know. It's cheaper to rent than to buy in certain areas. So the difficulty that everyone's having here is that the baseline has moved up 25%, right? As I say, roughly, in terms of which measure of inflation you want to use. Mortgage payments are up a lot more than 25%, especially interest only for landlords. But that's your rough number in the economy. So everything's 25% more expensive, so shelter's harder to come by. That's a bit tough if you haven't had a 25% increase in your income, in your household income, however it comes. Households are still saving. That's the latest data that we've got. Let's see what the trend is in Q1 2023 and Q1 2024, when we have the figures. But ultimately, there's also been more geopolitical escalation really rather than less, especially in the recent week. And there's now a lot of chatter saying Kyiv is going to fall to the Russians. I don't have any expertise to offer in that department, but it's worrying chat to see nonetheless, of course. Investors are still selling more than they're buying, so that's shortening rental supply even more. And arrears and insolvencies are up, but they're still under the historical averages and they're at manageable levels. Of course, we need to watch the trends particularly closely, but that's where we are. So I hope that was helpful and you enjoyed that summary. Thanks.